In this presentation, we'll talk about a timely subject, retirement income. And this subject is quite timely because so many of the baby boomers are entering retirement each and every day. And they're entering retirement facing a myriad of challenges. Those challenges include longevity risks, the risk that the retiree is going to outlive their income, a real probability with medical advances and improved health care services. Inflation which takes a bite out of the purchasing power moving forward. We know what that is, but the cost of living can accelerate. It can be an uncertainty. The sequence of market returns. We realize that the stock market is full of volatility and uncertainty. But the sequence of those returns can have a very meaningful impact on the portfolio. For example, a market drawdown at the very beginning, where there's reinvestment, can actually help the overall value of the portfolio decades down the line. But if that major shakeout occurs before that money is needed, or when the retiree is in a position that portfolio has to be protected, there can be major problems, major catastrophic impact on what happens. The uncertainty of future healthcare costs, clearly rising dramatically. Inadequate savings moving into the retirement period. Perhaps unsustainable lifestyle expectations. Changes in life circumstances. Changes in legislation such as income tax rates and estate laws. And also the demise of the employer pension plan, as more and more private employers move away from that pension plan, which provides systematic income, to one that shifts the risks to the employee, defined contribution plans. And that's one of the reasons that the conversation has really moved towards helping our clients create a floor of guaranteed retirement income which can cover those essential living expenses, putting food on the table, keeping the lights on, making sure there's heat in the home. Growth assets, the other part of the portfolio, can therefore be used for discretionary spending. I think part of our role moving forward as financial planners is to help to identify that gap between guaranteed retirement income, which will cover those living necessities, and then the growth portfolio assets, which can supplement, add to the discretionary spending. Two of the philosophies, investment philosophies that you studied in your Business 593 Investments and Portfolio Management class was modern portfolio theory, and you spent several weeks on that. And also the idea of life cycle investing. As you know, modern portfolio theory is based on the premise that the most important decision in investment is the asset allocation. An asset allocation that's appropriate for your clients' needs, their risk tolerances, their time horizons, their constraints, their preferences, and even their tax situation. That asset allocation put into in statistics for security, returns, volatilities, and correlations provide an efficient frontier, and that describes the optimal portfolio for a given level of return. In other words, the highest expected return for a given level of risk. Within those asset allocations, also the idea of diversification. The 2008 and 2009 market crash and the recession refocused some of the conversation the financial planning community was having towards an older philosophy, life cycle investing. You probably recall that discussion in your course, but let's quickly review that. The idea of life cycle investing is that personal wealth is a function of two components: financial wealth and the value of your human capital. In other words, the present value of that future earning capacity. When someone is young with human capital high, in other words, there's a long term there to get income. Also, their work is providing systematic income. Then the financial assets can be invested for growth. They don't need to support any systematic savings, or I should say systematic cash flows to help pay for the essentials. They can be focused on that long-term savings, that capital appreciation. On the other hand, as our clients approach retirement and their projected time period for when they will stop earning or stop working starts to get shorter, then there's a shift. Because at some point, the financial assets will have to provide that systematic income. And that's where we start to see those shifting from growth to income. Let's talk about how we might start to create some more guaranteed income. How we can help our clients create that floor for essential living expenses. Well, first of all, is Social Security. And Social Security is a life income stream. The problem is, it's not a lot of money. We know that because Social Security was never meant to be a retirement plan. It was meant to be a safety net to ensure that our workers had some money coming in for the essentials: food, heat, electricity, shelter. 3 strategies that you could apply here would be early benefits, normal, retirement, age benefits, and then delayed or late benefits. As you recall from your Business 505 Retirement Planning Employee Benefits course, early benefits can start at age 62. If you do that, there is a penalty, and you'll receive about 70% of what you would have received at full retirement age, 65, 66, in that range there. Again, you could do the calculation based on the numbers you learned. Normal retirement age would give you 100% of your primary insurance amount, your PIA. And by delaying it, you can increase your PIA by 8% a year. So someone whose full retirement age is 66 and retires at 70 would receive 132% of their PIA. And in this interest rate environment, that's a good deal. That's a strategy you need to think about. Of course, think back to your discussion about the concerns about the viability of the Social Security system and how that plays into the mix. But I would like to point out one item, and that is Social Security is not just one bag of money that's being given out and then it's going to be going on. Social Security is a pay-as-you-go system. The problem is that the baby boomers, a large percentage of our population, are now entering the retirement period. And there's fewer workers supporting that. And so without some fixes, the PIA may be reduced. And I've heard numbers as low as 70% of PIA. So you can have those conversations with your client. And certainly it makes sense to be conservative and perhaps don't project the full 100% PIA. You also learn that the non-working spouse of a wage earner is entitled to 50% of the worker's PIA at full retirement age. A spouse who is a worker is entitled to either their own, based on their own work history, or the spousal benefit. In a situation where you have 2 spouses who are working, one strategy that you might consider is for the higher wage earner at full retirement age to file and then suspend their benefits. The idea there is to delay it to age 70. The reason that they file is what allows the other spouse who has the lower projected PIA to put in a restricted application at age 65 and start to draw down their spousal benefits. The restricted application means then that later, when they're age 70, they'll stop the spousal benefits and then they'll start picking up their own benefits, which have now be worth 132%. Very useful strategy. Note, if either one of the spouses files for early benefits, then this strategy no longer applies. Undoubtedly, you'll be working with some clients who are receiving some type of pension, whether they're government employers, former military servicemen, men and women, or they are working in the private sector and they do in fact have employer plans, defined benefit plans, cash balance plans. But even if that's not the case, if your client is a worker, participated in an employer plan, which was the defined contribution, you need to have a conversation about how that money will be taken. Right now, the numbers I hear is well over 90% of employees who retire are taking lump sum distributions. That may not be the best choice when you're trying to create a systematic cash flow. Annuities are a wonderful way of building streams of income that your client's not going to outlive. Some of those products could be an immediate annuity, particularly for those clients who are in retirement. A deferred annuity may start when they begin retirement, could be later. In fact, if you're delaying that annuity until the client reaches age 85 or 90, it's referred to as longevity insurance. Variable annuity with guaranteed withdrawal riders, laddered annuities. All different strategies, again, to increase that floor of systematic income. In this strategy, we're using individual bonds that come due at the end of the year. And you see on this image, I have 16 years of bonds, and at the end of every year or the start of the next year, whatever way you want to think about it, you could use that money from the bond to help pay for the expenses in that coming year. If it's not needed, it could be flipped to the end, and in a few slides we'll follow up on that idea. The reverse mortgage, or the home equity conversion mortgage. This provides ongoing monthly income sources until the homeowner moves or dies. Note that the homeowner needs to be at least 62 years of age with equity in the home. The bank or the lender who is on the other side of this reverse mortgage will agrees to pay the fixed monthly amount. Note that the interest charge itself is a variable rate. Typically, the homeowner will still considered to live in the home until they've been in a nursing facility over a year. At that point, the note would be called. If, however, there's two spouses and one's in a nursing home, then that doesn't apply. With one in the home, that's still in use, and so that the mortgage would not be called. Now that you've established that floor, let's take a look at the other assets, the assets that have the ability to be placed for some growth. With guaranteed income in place, the client is more inclined to stay invested in the growth portfolio. And this is really important because the worst situation is to have the client panic because that is their full nest egg, and to sell at the absolute worst time when they don't have that ability for that snapback rally, the ability to grow. So with that guaranteed income in place, it effectively rises the risk tolerance profile. Growth assets could be used for the discretionary portion of it, as previously mentioned, the systematic income for the periodic and ongoing necessary expenses. The growth portfolio can also be rebalanced at some point to throw off greater cash flows when in fact that systematic income is not enough, perhaps because of cost of living, the purchasing power. Here's just an example of how you might do that. Take some of those growth assets, move into fixed income assets such as income REITs or private debt programs, individual bonds or bond exchange ETFs, bond mutual funds. For the growth portfolio, I think it's useful to once again go back to a subject that you learned about in the earlier classes, and that is the idea of creating growth buckets. You would have, or you should have seen the one article referred to as age banding. In this age banding, retirement is looked at as no longer as one big period. it's bands, or you could look at decades, or however you want to look at it. But saying that there's this first period and second bucket and third bucket, that gives you the potential to restructure the asset allocation in each of those buckets, so that that last one, that last band, that last bucket, which gets used perhaps when the client's 85 or 90, could be positioned for more risks because it has a lot longer time horizon to use compounding interest. And as you get closer, then start to get more and more conservative. So I think it's useful to think about positioning your growth assets by thinking about the idea of different buckets based on time horizon, how that impacts risk tolerances, and how that can compound. Let's go back to that idea for a moment of combination, a bond ladder, in this case with a growth portfolio. The idea before was that the bond, as it comes due, would be used for that next year's living expenses. In combination with a growth portfolio, there's a possibility that the bond proceeds may not be needed because there's enough capital appreciation in the growth portfolio. That capital appreciation can be used. The bond can be spun out to the end, add one more rung on the ladder to extend that ladder higher. So you can see when years that the market goes down, the proceeds from the bond could be used. Or in times that the market goes up, particularly those really nice years, use some of those capital appreciations and cash flows and extend that bond ladder out. In this video, we talked about an important subject, and a subject that is a real hot topic right now. That's retirement income. You explored ways of helping your client build that floor, that systematic income for essentials, and then how you might position the growth portfolio.